Hi, welcome to this introductory video where we get into depreciation and amortization and how we actually account for it and what the journal entries are. A lot of you have wanted to talk about this because you're like, ooh, I know my assets are losing value and we're not accounting for them, and this is going to come up in a lot of questions early on. And that's one of these things about accounting classes, that people have questions about all the different parts all at once, and you're like, ooh, just wait. So those of you that have been waiting for depreciation to be able to talk about depreciation, this is the video where we start it, and then we're going to talk about the different methodologies where we depreciate assets. Okay, so there's assumptions made by managers all the time in accounting, because it's really hard to calculate a lot of this other stuff, and there's not much value in it, so getting it super precise. And so we say, okay, what's the ballpark for it? And so depreciation and accumulated depreciation follows this kind of process where there's different assumptions that could be used to depreciate assets, and one is not good and one is not evil or bad. It's just one might be more inclined or beneficial for the business and one might not be. And we need to know the assumptions and know whether or not, know the motives for using them, how inaccurate they might be, because we have these standardized assumptions, but a lot of times things don't depreciate in a very standardized way. Case in point, the airline industry with the original Boeing 737, they thought those were going to last a lot shorter period of time than they did. They ended up lasting a lot longer. And so these assumptions are really important, because if we've impaired an asset or an asset is not there, all of a sudden we look like we're really efficient, or we don't need many resources to actually use in our business, but it turns out we do, right? So we had that prior video about the zombie satellite, right? So that's a perfect example where if the expenses don't match up in the right periods, we end up looking like we don't have a very many assets when we really have more. And we also look like our expenses are off too, because we don't have the depreciation. So what we're looking for is to depreciate, hopefully similar to what the life of the asset would be. And so that's what we're doing. So what is depreciation? Depreciation is the recognition of the loss of value of an asset that you own. So let me give you the example, and everyone with a kid will have this as they'll understand this. So like I said, I have 5 kids in my family, and our car was very nice when we bought it, but eventually, and now it's just it's a rolling piece of garbage in a lot of ways. You got French fries in all the cracks. I can't tell you how many times every single kid has puked in it. I think every single kid except for one has puked in it. And then we've got, you go to the back and, you get your kid a milkshake, and you're like, oh, I got my kid a milkshake. They're going to love me. It's going to be awesome. Except for they leave that milkshake in the little cup holder for like 3 months, and they never think to bring it out. They just look at it and go, that's gross. And then it gets it seeps out of the cup and melds to the thing, and you got to go clean it up because you smell it from the front seat. So there's all sorts of problems that happen as a result of owning this. And the question is as these things happen, what's happening to my car? The resale value is going down. Most of you know that buying a new car, you lose a lot of money when you take it off the lot, because if my choice is to buy a car from somebody on, Facebook Marketplace or Craigslist or something like that, or go to the dealership, I'd rather go to the dealership and go straight for the dealership, because I'll get a nicer car. So there's a bigger drop in value because there's a lot more uncertainty. I'm buying from some no-name Joe versus a dealership. There's a value to that people value, and so there's a big discount to when you drive it off a lot. So depreciation is something that happens to assets, and what we do in accounting is it's the process of allocating the value of this long-term asset over time and the expense over time to our income statement to acknowledge the expense of the asset over time, so that our income reflects that we're using up some of that value. We also have to account for our asset not being worth as much. So we have a depreciation expense, and then we got something else going on with our asset that we have to account for. And if you think about this, this is very consistent. This is a very consistent principle. What we talked about earlier in the year to kind of get you comfortable with this idea of like this backwards thinking of sometimes, if it feels weird, of like a prepaid expense. A lot of you had a hard time getting your mind around it, but all of you know now, a prepaid expense, that is always an asset, because it's a prepaid expense. It's a resource that you're going to be able to use up in the future. Well, what's an asset? An asset is a resource that you get to use up in the future. Now, depreciation might indicate that less of that asset's there, although the entirety of the asset's there, the value is gone. And so that's what we're accounting for. And so let me tell you about the biggest impairment I've faced with an asset in this. So I was swimming with my son. We went to a swim lesson, and I was talking to the instructor. And he said, "Hey, Dad, can I go wait up by the car?" And I said, "Sure. Yeah, you can go wait up by the car. No problem." So he goes up to the car. He's waiting up by the car. And when he waits up by the car, I come up maybe 10 minutes later, and he's taken a rock and drawn pictures all over my car with the rock, like keyed the car basically with the rock. And he drew a house, he drew a couple of people, and it wasn't just on the front, he drew on every single panel of the car. And I did what every good dad does. I lost it, and I got really upset. And it was a very funny moment because my son, I was saying, "Porter, you scraped the entire car. This is really bad. You know, people go in jail for that." I was trying to get him. "This is really bad." He said, "I didn't scrape the entire car." I said, "Yes, you did." He goes, "I didn't scrape the roof." And I laughed because he was right. He didn't scrape the roof, but he did scrape everything else. Anyway, my van lost value that day. These things happen, and the value gets lost over time related to different assets you own. And in a business setting, we depreciate them. So let's go through some terminology stuff first. The depreciation is a process of systematically allocating the cost of long-lived assets over the period during which the assets are expected to provide economic benefits. Depreciation, a term commonly applied to physical long-term assets, such as plants and equipment, not land, is what we expense related to those assets. Amortization is applied to intangible assets. And amortization and depreciation are pretty interchangeable as far as terms, except for there is, with amortization, there's a finite useful life. It'll end up being gone. And depreciation, you'll have accumulated depreciation that will accumulate over time and then will be gone as soon as we sell that asset. As soon as we get rid of that asset, it will be gone. So depreciation methods, we have the straight line, accelerated, and units of production. We're going to spend a couple videos going over those. So let's talk about depreciation. What happens with depreciation? So we have an asset over there on our books that will maintain a debit balance. And then we create this account every period, and it's called accumulated depreciation. It's a contra asset account. It's similar to our contra asset account allowance for bad debts in the sense that allowance for bad debts nets to our accounts receivable, and the net balance between those two is what we'd account for in our accounts receivable, because that allowance for bad debts lets us know we don't know who the Tucos are, but somebody is not going to pay us. We do know that it's lost value. We don't know exactly, but we do know it's lost value, and so we're going to have accumulated depreciation as a contra asset balance. It's different than other things, like when we credit cash, we credit that cash and it's gone. The accumulated depreciation is something that we accumulate over time, we keep over time, and we net that to our assets. And as soon as we sell an asset, we're also getting rid of the depreciation related to it. So it would be debited when we sell an asset, but it maintains a credit balance on that accumulated depreciation. When we write accumulated depreciation, we also have a depreciation expense. All right, that we put on our income statement. So we would credit accumulated depreciation, we debit depreciation expense, credits equal debits, everything looks great, and that's what we do. So it's a contra asset called accumulated depreciation. The depreciation expense gets reported, and these are all assumptions. So don't think there's any precision here. There's not precision in this calculation. When it comes into this, there's very low precision, particularly with straight line and double declining. So companies don't use the same accounting assumptions when reporting their income statements and financial reporting. So when they report to the IRS or for the income when they report to the IRS or to their shareholders, and this bothers some people. Some people have a hard time getting around this, but there's two sets of books. There's a book for taxes, and then there's a book for the business. And the reason why is because there's investors and government. And the reason why this matters is because depreciation methodologies frequently are tied to these things. And so the government might have a different incentive and might say, oh, I'm going to allow certain depreciation methodologies. And investors just really want to have some sort of accurate allocation. So the government might provide some benefit to buying new equipment and updating equipment and things like that. Whereas investors, we just want to make sure that things are running right and we're getting a good return. So straight line depreciation provides a standard assumption about the useful life and costing of an asset for investors. It's called the peanut butter approach. Basically, we just take the amount of years we're going to use it and peanut butter spread the value across all the years evenly. Just a peanut butter approach. That's what straight line is. A lot of you like that because it's so easy. Double declining balance is, or accelerated depreciation, is used by many governments around the world to encourage investment. So double declining balance says you could get to depreciate more in the first year and in the early years of the asset's life than in the later years. The benefit of that for those that pay taxes is that if you buy a new asset, you'll pay less in taxes because you can net more of that value into that those early years. The nice thing about double declining balance, it feels more like the reality of depreciation in a lot of ways, in the sense that you lose a lot of the value up front, but neither one of these is particularly precise. So that's depreciation and accumulated depreciation and depreciation expense. In the other videos, we go through some examples of how to calculate these things and try to get you up to speed on all of it. See you in the next video.